Good morning, I'm Guy Johnson. Welcome to Squawk Box Europe this US Labor Day. Today's guest host on the show, Emily Sanders, CEO of Sanders Financial Management. Emily says there's a 40% chance of a US recession in 2007, highlighted by the inverted yield curve. She expects 2 more rate hikes from the ECB this year and 1 more from the Fed, interestingly enough. And she says that corporate profits in the US will continue to grow over 10% this year.
The US economy is the largest in the world, the leader of the OECD, and really the driver of the world economy because the U.S. consumers are so prodigious in their buying. So there is a fear that if there's a slowdown in the U.S., that would ripple to the rest of the world. But let's not forget that the GDP in Eurozone is at 12 trillion, is equivalent to that in the U.S. There is buying power in other parts of the world. And the growth rates in the U.S. have been good, but other countries have been better.
Why is the US yield curve inverted at this point in time? Why is the market pricing in the possibility of the need for the Fed to be cutting sooner rather than later?
In my opinion, that's wishful thinking because the yield curve shouldn't be inverted. And I'm surprised that it is, frankly. I would call it a gently sloping yield curve. Yeah. So it really shouldn't be inverted.
You obviously placing clients' money all the time. How big a proportion have you got ex-US right now, and how much of that is subscribed to Europe?
Well, 15 to 20% of our investing is ex-US, and that's set to rise in the future. So over the next few years, that could go as high as 40%, but we're staging it in. And probably about half to 3/4 is in the Eurozone, with the other parts being in Asia and some in Latin America.
Some of the large financial institutions, some of the pension funds have been divesting large cap stocks over the last few years to make their pension funds look as the actuaries want them to. Do you think that trend is now over?
No, I don't think the trend is over, but I do think that momentum is rebuilding in the large and mega caps, particularly in specialty areas such as defense or some pharmaceuticals, playing on the demographic trend of aging U.S. population, aging world population in developing countries.
That's quite a collective mix of stocks. What is there a theme running through those picks there? Is there something we can tease out?
Well, they are eclectic, and the theme really is, the one good idea is move into more international exposure. Right. Some of these stocks are purely international plays, and others are building their non-U.S. business up.
You talked in the notes that we read ahead of this show today about the water industry and how interesting you find that. A lot of people have started to discuss this. We ran a special on it a few weeks back during World Water Week about the lack of potable water out there and how industrial use of that is actually consuming the vast bulk of it. For companies like Suez, are they going to be the next oil companies as water is effectively revalued? How does that happen, and how do we actually price this in?
Well, actually, water is the new oil, and when you think about it, humans are so dependent on oil, yet they can live without oil, but they can't live without water. And 1/3 of the humans in the world are short of water. And 98% of the world's water is salt water. Yeah. So the processing of it, the treating of it, the making it available to humans who are short of water as opposed to just agricultural and commercial use is very important. I mean, look at GE. They made a major multi-billion-dollar investment in water recently. So that's a precursor of things to come. And yes, I'm sure Suez would love to capitalize on that trend.
Louisa, jump in. Yep, Emily, are you looking for less risk? I was speaking to someone the other day saying that now might be a time to position yourself slightly differently, look for a little bit of less risk in the marketplace, maybe start looking towards some of the high yielders out there, look towards some of the stocks that give you a nice dividend as opposed to some of the more risky growth stocks in the environment where you may have seen rates starting to top out. How are you positioning yourself in the risky versus the less risky?
Well, our firm always likes stocks that pay dividends. They are more stable, but in the U.S. anyway, which is a more mature market, we're looking toward the large stocks as being geographically diverse and really having some downside protection against a possible recession in the U.S. But we still love the international stocks, the emerging markets, just in smaller doses. So the risk appetite is there to boost overall return, but for the stability, we do go to the dividend-paying stocks.
What's your take on technology right now, Amy?
Well, the NASDAQ is flat for the year, so it looks to me like it definitely has room to go up and to catch up with the S&P and the Dow. And also, corporations still do have a war chest of cash, and they are putting that money to work. Ben Bernanke talked a lot about productivity and continuing to have the U.S. Cornerstone of productivity. And the way you get that is by investing in technology to boost the efficiency of your workers, and corporations are doing that.
We talk about technology as if it's a uniform growth area. Some very interesting technology is coming out in energy at this point in time, in water, in the kind of technology that we're seeing develop there. Is that the way to play technology at this point? Industries that have got a clear upside in terms of their sort of the demand that's going to be coming through in the future, whereas other areas demand less clear. How do I play it from that sort of perspective?
Well, that's a good way to look at it, because so much of technology nowadays is software driven anyway. So, software for the energy industry or software for the defense industry, that's really the driver.
Emily, it's been a great pleasure having you here this morning. Thank you very much indeed for your time. Emily Sanders, our guest host. Keep ending.